Before we begin, a critical reminder. I am not a licensed financial advisor, CPA, or attorney. This video provides general market analysis and educational content only and does not constitute investment advice. Precious metals are speculative assets which may experience significant price volatility. Please consult a licensed professional for tax, legal, and investment advice specific to your situation. The price of gold and silver fluctuates daily, but those fluctuations are driven by deep, fundamental economic and systemic dynamics. We're going to analyze three primary mechanisms that historically influence the underlying demand and supply of precious metals. By understanding these value drivers, you can better contextualize daily price movements. This dynamic centers on the impact of real interest rates, the interest rate adjusted for inflation, on non-yielding assets like gold and silver. The problem with gold. Gold is a physical store of wealth. It does not pay a dividend or interest. The trade-off. When the U.S. Federal Reserve raises interest rates, yielding assets like treasury bonds and savings accounts become more attractive, increasing the opportunity cost of holding gold. Investors get paid to hold cash or bonds, but not gold. The historical effect. In periods where real interest rates are high, meaning returns on cash bonds are significantly beating inflation, demand for non-yielding assets like gold is historically dampened. Conversely, when real interest rates are low or negative, gold's lack of yield is less of a disadvantage, and its demand as an inflation hedge tends to rise. Gold and silver are priced globally in US dollars. This technical fact creates a fundamental inverse relationship with the dollar's value. The dynamic, the US dollar index, DXY, measures the dollar's value against a basket of major foreign currencies. The pricing effect. When the US dollar strengthens, DXY rises, it takes fewer units of that stronger dollar to buy an ounce of gold. More importantly, it makes gold more expensive for investors using every other currency, euros, yen, pounds. This decreases global demand and places downward pressure on the dollar price of the metals. The hedge. Historically, the price of gold often rises when the dollar weakens, acting as a historical hedge against the depreciation of the U.S. currency. Historically, the price of gold often rises when the dollar weakens, acting as a historical hedge against the depreciation of the U.S. currency. This dynamic is driven by investor psychology and the global financial environment. What it is, gold's demand for centuries has been driven by its role as a monetary insurance policy. It is one of the few global assets that is not simultaneously someone else's liability. The triggers. Demand surges occur during periods of low systemic trust, often triggered by geopolitical crises, banking instability, or severe sovereign debt concerns. Central bank action. This dynamic is confirmed by central bank behavior. When central banks lose faith in fiat currency stability or geopolitical safety, they often increase their strategic gold reserves, confirming its role as a fundamental safe haven asset. Conclusion. Contextualizing market movement. Understanding these three mechanisms, opportunity cost, currency denomination, and systemic trust, allows you to evaluate daily price action with context. These are the engines driving the long-term supply and demand curves for precious metals. Our analysis is purely for educational purposes to help you understand the market's forces. What other macroeconomic indicators do you see as having the strongest influence on the value of commodities? Let us know in the comments.